Dear investors, in this period we have seen indices register a new all-time high. Let me share some of the thoughts at this juncture. A usual question that is in the minds of the investors is that while the economy is seeing a slowdown, yet markets are at a new high. Quarter two result season was weak. Earnings were helped by tax cuts, else they were flat to down. However, what is happening is while there is a softness in the economy and we do believe it can persist for some time, what we have seen is that interest rates have also dropped significantly from their levels seen a year back. And hence, today, a lower cash flow stream over the future is being valued higher because the discount rates have reduced. This is one reason why we are seeing markets at a new level. Apart from it, many sectors have been able to withstand the slowdown much better versus others. B2C businesses which have pricing power have benefited from lower commodity prices in this period and have seen strong gross margin expansions, and with even 5-6% sales increase have delivered mid-teens kind of earning increases. So FMCG, many strong retail banks, even companies in the cement sector have seen this and have benefited. We believe this could continue in the future as well. Our portfolio companies belonging to the high quality space have seen very sharp benefits from the tax cuts. And while our portfolio PBT growth has been in the vicinity of 20%, our profit after tax growth has been in the mid-30s for our portfolio. Going forward, we believe the benefit of the lower taxation could sustain better for B2C businesses versus B2B businesses. And on this count, our portfolios are nicely positioned. Over the next 5 to 6 months, the market has a lot to look forward to. For one, we are looking at three large deals happening on the FDI front. BPCL is something that the government wants to sell before March. We are looking at Essar Steel getting sold by end of December, and over the period of 5 to 6 months, maybe Reliance would be able to sell a 20% stake in its refining and petrochemical business. All of these three large sales themselves could bring in between 20 and 30 billion dollars of FDI flows in the country. It would have the impact of bumping up our forex reserves and at the same time bringing in liquidity into the banking system, which would then allow banks to lower both lending rates and deposit rates. We believe this could benefit NBFCs, stronger ones, of course, retail-oriented banks where lending is more fixed in nature in terms of interest rates, and of course the broad markets in general. The construct of the market today is interesting. It is seeing a lot of support on the top 200-250 names by market cap. This is a part of the market which sees very steady domestic flows from mutual funds, insurance, pension funds, and some bit of this is structural. So in this part of the market, I keep saying this, but if I sell domestics buy, the market is in a very narrow band, and when FIIs get positive and they start to buy, we see the market move up sharply over a short period of time. The same is not true for the broad market, where we believe the earnings softness could sustain for longer, and hence, we have kept our focus on the larger mid cap, large cap part of the market very, very sharply. Happy investing. Thank you.